Good morning, everyone. Welcome to this morning's webinar. Thank you so much for deciding to spend a few minutes of your day with us. We are just very grateful that you've chosen to connect with us today. My name is Chris DeBacker. I'm one of the regional vice presidents here at the Free Methodist Foundation and also one of today's presenters. And we have got just a lot of really good information that we are hoping to share with you so you don't end up looking like this gentleman. We know if you're right in the middle of preparing taxes, or just maybe even the thought of preparing your income tax return can make you look like this guy. That's one thing we want to help alleviate today. And we, like I said, we've got a lot of information that we are hopeful and that we anticipate will be helpful for you as you look at last year's taxes and then plan ahead for this year. But we know too that there may be some specific questions that you have that we don't hit on, and we want to make sure that you feel comfortable, and we encourage you to email any questions that you might have during the course of our time together. Feel free to email those anytime during our webinar to the following address. It's webinar@fmfoundation.org. And again, that's webinar, WEBINAR, @fmfoundation.org. And we are going to take some time at the end of our webinar today to answer as many of those as we can.
So, Chris, I get kind of dizzy just looking at this guy. All this paperwork, it seems like it's about ready to collapse and fall on me. But I think we'll make it here.
I think we're going to make it. We're off to a good start.
Okay.
So before we do that, let me introduce again. My name's Chris. The other two gentlemen who are going to be presenting this morning are Tim Burkhart, who's the Vice President of Estate and Gift Planning, and Kirk Hoffman, as well as is with us today, who's our Director of Financial Planning at GuideStream Financial. And before I turn it over to Tim and before we just jump into to this material, I'd like to open us up with a word of prayer to help us focus our minds and energies in the right direction. So if you'll open us up, or if you'll join me as I pray, then we'll get started. Lord, thank you for giving us this time when we can examine finances, and specifically how those finances are taxed and how we can be wise with our finances in that regard, and look at it in the light of your word. So we're grateful that we have this opportunity. We're grateful for the technology that's allowed us to be able to share and for those to be able to hear, and just thankful for each person and the time that they've set aside to really look at becoming better stewards, or the best possible stewards they can be with those resources you've entrusted them with. So Lord, again, we give this day to you, we give this time to you, and we just, in all things, praise you. In your name we pray. Amen.
Amen. Thank you, Chris. It's great to be with everyone this morning. My name is Tim Burkhart, and we're going to begin just with an appropriate orientation, the fact that we don't even want to begin to say that we are your tax advisor and what we're getting ready to communicate today. You need to know that tax advice and legal advice, they should always be done within the context of a person who really knows you very well and has a clear perspective as to where you're at. And so what we will be sharing is a number of educational ideas here that will help all of us to just kind of focus on some key ideas and some concepts that are in general very good for people. And so we would encourage you, if you have more specific questions, feel free to give us a call. We'll try to resource you and get you in touch with the right person that can assist you. And always in the work that we do here, we like to orient ourselves from a biblical perspective. And you may have even thought of this as you thought about taxes. It's like, wow, there's some great verses that deal with this, and probably the most prime verse comes from Mark 12. And I'm just going to read this, and it's just a fun verse, I think, to help us get a good perspective on taxes. Later they sent some of the Pharisees and the Herodians to Jesus to catch him in his words. They came to him and said, "Teacher, we know that you are a man of integrity. You aren't swayed by others because you pay no attention to who they are, but you teach the way of God in accordance with the truth. Is it right to pay the imperial tax to Caesar or not? Should we pay or shouldn't we?" But Jesus knew their hypocrisy. "Why are you trying to trap me?" he asked. "Bring me a denarius and let me look at it." They brought the coin, and he asked them, "Whose image is this, and whose inscription?" "Caesar's," they replied. Then Jesus said to them, "Give back to Caesar what is Caesar's, and to God what is God's." and they were amazed at him. As we reflect on this this morning, I'm even amazed just thinking about all that we know here and you know in regards to taxes and the orientation that Jesus gives us here, and the fact that there's two primary characters in this word of advice that Jesus says. And the first one is to give back to Caesar what is Caesar's, give to the government what is the government's, and realize that they protect us, they do wonderful things for us, provide us so many structures of law and order. We should no doubt be honoring our government, praying for our government in that regard, and then also to know that what's God is God's, and what an amazing concept, such a great truth. It doesn't say here what's yours is yours, but there's really just two concepts here: give it to Caesar what's Caesar, give unto God what is God's. And it just made me just think about our currency and what a wonderful communicator it is of this particular scripture, and the fact that there's no doubt about it. When you look at the currency, you know that this is the United States of America, and we use the currency. It's a great tool, but ultimately it's in God we trust, and those two concepts are born in that. And I think it's a great guide for us in our stewardship as we consider all the things that we're going to be talking about here this morning. So what an amazing scripture, what a great truth for us, and we use that as the starting place for our discussion on taxes and all that involves.
Yeah, I think, Tim, that's a great way to start, and really that should be our anchoring point with everything that we do. But it can be a little intimidating sometimes when you start getting into taxes, and especially this time of the year when you're really required to report everything that you paid in taxes, and you need to make have a really good account when you're reporting to the IRS. It almost feels, in a lot of cases, it's like us against them. And the IRS has really become a lot more user-friendly over the last several years. And as a matter of fact, they have something called the Taxpayer Bill of Rights that they've published. And if you look through this, they really are saying you have the right to report, you have the right to dispute us if we say that, or if we think you're reporting this one way and they maybe misinterpret, you've got the right to dispute that, and they encourage you to do that. And as you read through a lot of these things, really what it comes down to is they're saying if you're an educated taxpayer, if you're an educated citizen, you have every right to engage with us. It's not just us against you, but we want you to be very educated, very informed. And our goal, again, through this webinar is, really equip you with maybe it's just one or two things that you can leave with to make you feel like you're a better educated consumer, because that's your right, and that's your well within your bounds of being able to do that.
Chris, a lot of what we're going to be talking about this morning also, there's a lot of places you can go for tax information and resources. So just to capitalize on what you're saying there is that the IRS.gov site really does have a lot of resources. We're going to be touching on some of those. So as you Google certain things, it's amazing how many times you can get right back to the tax code, which is the law, and where we're working and where we're taking our ideas from. So it's really comforting to have that perspective and to know, and that sometimes it's better to check it out, especially when you see something on the internet.
There's roughly the expectation is that there'll be $1.2 trillion that folks who itemize their income tax deductions actually claim this year. 45 million tax-paying entities, 45 million of us will itemize our deductions this year, claiming roughly 1.2 trillion. Yet there are still a good number of folks who will choose to take the standard deduction. Another $747 billion will be accounted for in that way. And if you aren't itemizing your deductions, and you're kind of the mindset that I'm not itemizing because I took the standard deduction back in 1978, and doggone it, that's the way I'm going to do it now, because that's the way I started doing it, I would encourage you to re-examine that. That's something you really should look at every year, and it just shouldn't be something you do because you've always done it. There are so many creative deductions that you can take, so many new deductions that come about every year. So I would encourage you to examine that. If you do choose to take the standard deduction and you're over 65 years old, the good news is that there is an additional amount that you can claim as part of that standard deduction. If you're married, you can actually take an additional $1,200 as your deduction and another $1,550 if you're single or head of the household. But the takeaway from this is just don't do what you've always done, because you may be missing the boat. And of course, being March Madness, you want to know your brackets. And we're not talking about, we're not, well, I mean, we could.
I mean, I've been working on my brackets this week.
You've been working on them. You know, if you've been working that hard on those brackets, hopefully you've been working as hard on these brackets.
Okay.
You need to know what tax bracket you're in. You need, again, be an educated consumer and know you don't have to be an expert, but take a little initiative and I think probably maybe preaching to the choir in a lot of cases. By you being on this webinar, you're showing that you want to be educated and be up to date with a lot of these things. One of the things I hear from a number of people is, I don't make enough income. I don't have enough income to pay taxes, which very well may be the case, but it doesn't mean that you don't have to file an income tax return. Don't assume that just because, again, since 1992 you haven't had to pay income taxes, that you don't need to file an income tax return. Those two don't always equate, and there are certain income limitations that you know, if you do fall under these certain amounts, you don't have to file a tax return. But again, don't assume that just because you haven't paid taxes, you don't have to file that return. The IRS wants to make sure they have a good record of knowing your earnings and knowing your history. So make sure you're doing the math. Make sure, again, that you're not assuming that you don't have to file a return.
You know, Chris, I ran into the same situation here within the last week where someone was settling the estate for a relative, and in fact, the relative hadn't filed their taxes since the early 90s, and the IRS wrote them a nice little letter and said, by the way, we haven't had tax returns since this amount of time. And so what a difficulty that individual was going through just to try to make sure that they were doing things right. And so by filing, at least you know that you've declared to the IRS where you're at with that on your taxes, and it does alleviate a lot of concerns that might come up some point in the future. And so just encourage you to at least look at the minimums there, do the math, and figure it out.
Like you had mentioned earlier, Tim, by going to the IRS's website, irs.gov, they have become very user-friendly. And if you go to this site, there's a part of their website where you can plug in a couple of basic pieces of information about your personal situation. So everything from your age to your income to the state that you live in, maybe your military service or history. And by entering that information, they will direct you to a number of different software providers or a number of different sites that you can potentially use to help you prepare your income tax return, many of those without cost. And it's a pretty simple process. It may seem a little bit complicated, but once you get into it and you explore a few of these websites and some of these software packages, you realize it's an easy way to make sure that it, like we had talked about, itemizing deductions, it's an easy way to make sure you're not skipping something. You know, if you're used to doing that by hand, it's very easy to overlook some of those new deductions or some of those new credits that come along. So some of these software packages that the IRS encourages you to use are really helpful in making sure you're doing a very complete, thorough job when you're preparing your income tax return.
And certainly no endorsements here, but this is really not hard at all. I just did this myself and entered in an age for a person, approximate adjusted gross income, your state of residency, because that's an impact here, whether or not you have an earned income tax credit. That's one of the big issues this year as it would relate to the free tax software. If you're underneath that level where you're getting the earned income tax credit, then this is a place where you could directly benefit. And then depending on, again, your scenario, you should click on these various programs and figure out which one might be better for you, and understand that some of them may even offer a free state tax preparation, and some of them may actually charge you for that. There are actual companies that will do both free federal and state depending on whether or not you fall within their guidelines to do that kind of thing. And so it's a great benefit. You know, I've used a tax software for over the last 20 years, me and my wife personally. It's a great tool. I know that each year when we go to enter in our information, it already knows my name, it already has all my vital information, my Social Security number. It already knows that I've been depreciating certain assets, and so by doing that depreciation, I don't have to re-enter that information in each year. And in fact, depending on who your custodian is for your investments, you can use an import feature, which will allow you to import the actual tax data from your investments directly into the program, so you're not spending countless hours putting that information in. So I know our GuideStream Financial Division also has a similar type of service that's available, along with, I'm sure, many others provide that as a service to really make your taxes that much easier.
Helps you be really organized if you use the same kind of package from year to year, doesn't it?
And that's our next slide. And we're going to talk about being organized. It's just such a key element of doing what we do with our taxes and getting into a system that really works for you. You might even think about this year writing out a little checklist, and step 1, step 2, step 3, things that you've done as you do your taxes. It's a great thing even to think about as you get more aged, to be able to help those who come behind you that might be trying to help you, the different things that you're involved in doing, making sure you keep the appropriate forms, such as your W-2s and 1099s, K-1s, things like that. Save all your receipts. We always encourage budgeting and those types of things. So if you're saving your receipts and you're going to have that information readily available, your pay stubs, and then your tax software, just like we were talking about. Some of them even track things such as when you give certain clothing articles of clothing and things like that to charity, they'll give you some recommended deductions that you might want to even consider, whether it's a worn shirt or a new shirt or something like that, that you can properly make sure you're using the right values for your deductions. Next thing is to just consider the fact that if you're an itemizer, just like our earlier slide was talking about, essentially do the math. Don't just assume that because you've always done the standard deductions that you should consider doing that again. We see for 2014 the standard deduction of $6,200 for singles and $12,400 for married couples. But it doesn't take much when you take your mortgage interest, your charitable deductions, and other various itemized deductions to add those all up and find that you might be missing some significant benefit as you do your taxes. So as we, especially those who are into charitable giving, which we would hope that all Christians are tithing, and by doing that, it really puts you in a position where you should strongly consider itemizing your tax deductions in a given year.
If you're using a software package, it walks you through the steps where you put in your data and it calculates, well, this is what the standard deduction would be, and this is what the itemized deduction would be. So the software, all the software packages do a nice job of walking you through those two options, and it allows you to select the higher deduction.
Thank you, Kurt. Exactly. Great reminder for us. And then we all value education, and there are some wonderful tax benefits out there to encourage not only our children to be educated, but for us. And so we just mentioned, especially on the loan side here, we want to get rid of those debts just as quickly as we can. And children that are not claimed as a dependent can deduct up to $2,500 of student loan interest paid by mom and dad. So that's a deduction for the child to help them get launched financially. The child does not need to itemize to get this, and mom and dad can't claim the interest deduction even though they pay the bill because they are not liable for the debt. So some key elements to that provision, but it's a wonderful thing, and certainly we want to be debt-free as we launch out in there into our careers, and here's a great tool, especially for our younger folks to benefit from. And then also the American Opportunity Credit, the first $2,000 spent on qualifying college expenses and 25% of the next $2,000 for a total of a $2,500 credit per student. And we encourage you to see the guidelines that would relate to this, but it's a wonderful way. The government is helping educate our young people, and even our people like ourselves who are maybe considering to earn a new skill and to sharpen the saw, so to speak. The lifetime learning credit for you or your spouse, $2,000 a year based on 20% of up to $10,000 you spend for post-high school courses again, leading to a new or improved job skill.
Now, Tim, how do I know, or what's a good indicator to know that if the coursework that I'm choosing to take post-high school is approved for a credit like this?
I think Kirk might be the best one to answer that because he just had some daughters go through that.
I do. So those deductions are only available for accredited institutions, and the best way to find that out is you get a tax form called a 1098, and those come from either the Department of Education or from the university or institution that they were attending. So any qualified institution is going to be generating a 1098, and if you're getting those are deductions that are qualified.
So the fact that I took some professional courses and didn't get a 1098, I better not put that on my taxes.
That probably would not be.
Okay.
Yep, that probably would not be good.
Good. Thank you.
Those are some pretty good strategies, Tim. I'm glad you shared those with us. Maybe this is one that, if those two don't work for you, maybe this is something that'll work. Maybe you can relate to this gentleman. Sorry, guys, I can't join you. I'm skipping coffee breaks for the rest of my career so I can retire 2 years early. That's a strategy. Right?
I'm not sure that's a tax deduction, though.
I don't think it is.
Well,
that's a pretty good strategy. What do you think about that, Chris?
Well,
have you ever recommended somebody do that?
That's a pretty simple strategy, but there's some other simple strategies that not only affect retirement, but give you some immediate tax deductions and are often overlooked. And so one of the areas that we encourage people to take a good look at and participate in is qualified plans through their employer. And the benefit of those plans is that contributions are withheld from your pay and don't show up on your W-2. So you don't even have to report it. It reduces your taxable income, so you have an immediate tax savings. And then ongoing, once those dollars are in the qualified plan, they grow tax deferred. And then you have the opportunity post-retirement to continue to defer those taxes by rolling over your qualified retirement plan to an IRA. Another area that's often overlooked is many of these plans have an employer contribution component, profit sharing, a match, but you have to be a participant in the plan to receive that. So if you're not deferring, your employer's not going to put any money in either. So those are a couple of areas: participating in the plan, and particularly if there's a match, to take advantage of that.
You know, what I like about this, Kirk, is that when you get in the habit of doing something like this, it's more or less out of sight, out of mind. Mm-hmm. And as I've met with people over the years, they tend to be more successful when they've gotten in this habit of doing this kind of thing, because they've already learned how to live off of the rest of or whatever they're getting in their paycheck. Yep. After they've made their contributions. And there are a lot of really important things that happen here. If you make an IRA contribution, let's say right now, for your 2014 taxes, which we're going to talk about in a minute, but you're lobbing in a bunch of money all at one time. Right. And there's a concept called dollar cost averaging, which says if you invest over time, you're going to benefit more from that. You're going to pay less for your investments, which means you're going to have more earning potential long term. And so the idea of doing it in a systematic way, I think, is always a good plan.
Yep. And there's a couple of things in regard to the qualified plans that people don't always realize. One is that because it's coming out of your check before taxes, if you decide I'm going to save $100 a month in my 401k plan, many times we're thinking, well, my pay is going to go down by $100. Well, it doesn't. It goes down by $70 because you're not paying the taxes on it. And then another very effective strategy is, as you get pay raises, increase your deferral when the pay raise becomes in. So back to your point, Tim, about being used to living on a set budget, just have those pay raises go right into the plan. So very easy. You don't have to report it. So when you do your tax return, there's nothing you have to put on the 1040 to say I did these deferrals. It's just taken right off your W-2.
And then again, one more is that those of us who are married, learning to live off one income and then considering the other income as a way that we can really be more aggressive in saving for retirement is another great strategy to think about. Not only saving, but maybe even giving.
Exactly. Yep. Our next slide is talking about specifics on some of the employer-provided plans. So there's a list there. The plans that you are allowed to do an elected deferral are the 401k plans, 403bs, And then STEPs and Simples allow contributions as well. The other plans are employer money only, but those are the plans that you can put money in. And then the next slide is a list of other tax-favored plans outside of your employment. So IRAs are an option. The nice thing about IRAs is you have the opportunity to make prior year contributions. So, for example, if you're doing your tax return right now and you decide it would be best tax-wise to make a contribution for 2014, you still have time to do that, right up until you do your return or April 15th. Roth IRAs are another vehicle. You don't get a deduction for the contribution, but the earnings, once they're in the Roth IRA, grow tax deferred. And ultimately, when you take the money out, there is no tax on the earnings. So you avoid tax completely. There are a couple tax-favored education plans out there. 529 plans are one. Coverdell savings plans are a second. The 529 plans are specific to higher ed. So it's college, post-secondary. And the way those work is contributions go in after tax. The money grows tax deferred, and you avoid any tax on the gains when it comes out for education. The limits on the 529s are pretty high. For most, it varies from state to state, but for most states, it's up to $250,000 you can put into a 529 plan. So there's a lot of capacity and with those. The Coverdell savings plan, the benefit of those is that it can be used for education expenses K through 12 as well as higher ed. One of the drawbacks of the Coverdell is the contribution limits are only $2,000 a year, so it's hard to get large amounts in there. But if your objective is to have it for K-12, that's a good tool as well. Cash value life insurance. Life insurance is tax favored. The IRS encourages people to protect their families and insure themselves. And so as the cash values in those policies grow over time, there's no tax on that. And ultimately, when the life insurance is paid out as insurance proceeds, that's income tax free.
You know, one thing that I think many people forget about on insurance is that if you use after-tax dollars to buy it, the benefits of what you receive upon the death of an individual are tax-free.
That's correct.
From life insurance.
Yep.
Versus if an employer buys it, it's pre-tax, meaning it's never been taxed, and the benefit there is actually taxable to the employee. And so that can be an important tax planning provision to think about that and understand that it may be better to buy it after taxes versus pre-tax.
Exactly. Yep. Municipal bonds are another tax-favored alternative. The interest on those municipal bonds is not taxable. And then the last bullet on here is annuities. And so our next slide talks a little bit more about annuities. Those are tax-sheltered and have two phases so there's a phase where you're making contributions, and then there's a phase where you're taking distributions. Again, money goes in after tax, the growth is tax deferred, and then you have a choice at distribution either to take a lump sum or you can take a monthly income, either a set amount or based on your life expectancy. You can even do a guaranteed life income. And regardless of what your choice is, you pay the taxes on the growth as it's coming out. The idea is hopefully that you are in a lower tax bracket in retirement than you were when you were earning, so you're paying a lower tax as the money is coming out of the annuity.
One of the great ideas with annuities, they actually have lots of application in different scenarios, but for an individual who has not really done as much as they should have, you can take a very large sum of money, and there are no limits, in fact, putting money into an annuity. So if you had $1 million and you wanted to put it into annuity, and it would be tax sheltered from that day forward, and all the earnings would be then compounding within that annuity product. And there's so many different options within annuities on how that would be potentially invested. But again, knowing that compounding would happen tax-free, and then of course the distributions would be taxable pro rata on those distributions. So it's a great tool for someone who maybe has been a little bit remiss or hasn't thought ahead in the earlier years to systematically put money away.
Yeah. And our next slide kind of reinforces that because, as you mentioned, Tim, there's no limit on the amount that can go into an annuity, but there are limits on contributions to qualified plans. The IRS says this is too good of a deal. We're not going to let you have too much of it. We want to get some taxes out of you. But these are the contributions for the various plans. So for 401k, 403b, you can defer 100% of your salary up to $18,000 a year. If you're over 50, they allow you an additional $6,000, so a total of $24,000. And then the contribution limits are listed below for the simple, which is $12,500, and SEPs and Kehoe, which is up to $52,000. So when we have one, to your point, Tim, with someone who's trying to sort of catch up, what they generally will do first is maximize the deferral into these plans. And then the question is, okay, I've hit my maximum in my employer plan. Where else can I put money that's tax favored? So the annuity is a great tool to do in conjunction with this when you're trying to do that catch up and get more money put away. Again, outside of your qualified plans, you have IRAs. IRAs limits both this year and next year are $5,500 per person. You get an additional $1,000 if you're over 50. And as we mentioned earlier, one of the benefits of the IRA is you can do prior year contributions. So you can do contributions for last year. Another thing that people often overlook when they're trying to maximize what they're deferring is you can do a spousal IRA contribution even if your spouse has no earned income. So as long as one of you has earned income, you can both do an IRA contribution. So we've had cases where a client is wanting to maximize, and not only does that person do contribution for himself, but also sets up an IRA for a spouse, even though the spouse has no earned income. And then the Roth IRA is a little different in that you don't get a deduction for the contribution, but again, the tax is deferred on the growth, and ultimately you don't pay any tax when you take money out at the other end.
Just a couple comments here, Kirk, on IRAs, and keep in mind that on an estate planning perspective, taxable or tax-deferred IRAs can be a significant liability to a family in regards to, you still have to pay taxes on that income. It's income waiting to happen. So there are various ways that you can plan. If you've contributed to those kinds of plans, whether it's an IRA or 401k, 403b, simple, SEP, Kehoe, all of those would be in that pre-tax category where we have, when someone passes away, it's what we call income with respect to a decedent. So from an estate planning perspective, it's something to really think about and consider as a part of your plan. The Roth is much different in the fact that that is income that you would receive at any point in the future, tax-free. And again, what's really nice about it, these are not ors, these are really ands, because, what we see is successful individuals will do as many of these as they can possibly do.
Yep. Yeah, one of the things that we talk about when we're working with individuals and doing their planning is the concept of tax buckets. And we like to have, ideally, 3 different tax buckets at retirement. So one bucket would be, say, your 401k, and any money coming out of that bucket's ordinary income. It's all taxable to you. We have a second bucket that is like the annuities, where it's partially taxable. When the money comes out, you're getting some of what you put in back, and then some of it's taxable. So that bucket's partially taxable. And then we have a third bucket that's tax-free, which would be the Roth IRA. And so if you have all 3 of those buckets filled when you get to retirement, then you can be very strategic with how you're receiving your income, and you can manage. We looked at the tax brackets early on in the discussion. You can pretty much decide what your income is going to be, taxable income is going to be, based on which bucket you pull the money from. In some years you might pull more from the tax-free bucket, and other years you might pull more from the taxable bucket. But that's having those and having all of them gives you a lot of flexibility and allows you to be very tax efficient in your retirement years.
So if I want to go back and work part-time in the middle of my retirement, then maybe it's better to take something out of my Roth that year so I don't push myself into a higher tax bracket.
Exactly.
So being able to work within that option.
Yep.
Great suggestion.
The next slide is probably not applicable to most of our audience, but these are what are referred to as non-qualified plans. They're discriminatory in that an owner or a key employee or an executive can set up benefits specific to them. And so we just wanted to touch on it, that those are out there as well, and those are referred to as deferred compensation plans, split dollar agreements, executive bonus plans. So there are other types of plans out there that are less common, but also can provide some significant tax benefits.
Thanks for sharing on those, Kirk. Those are all great ideas, great tips, and boy, we could go a lot further. We're going to go directly to some ideas about making charitable gifts, and this can be a real important part of our planning. Naturally, hopefully we're all doing what the Bible instructs us to do, is to tithe, but as we do that, we realize that things happen in our life. We may have a particular year where we have a windfall, maybe some more income than we didn't anticipate, and so we're going to give you a couple ideas on how to handle those kind of things, and using tools such as a donor advised fund, and of course, if you can itemize your deductions, you're going to benefit from this aspect of charitable giving and bringing more dollars back through your tax filing process. But just one simple idea here. This is an inefficient, idea, but it's what we see a lot of people doing. And so let's say you have an appreciated stock or piece of real estate. You gift so much money out of that, or you have this intent of making a gift from it. And instead of actually giving it in kind, we take it and we sell it on our own, and we take the money left after taxes and we put it in our checkbook, and we turn around and we make a gift to ministry or to charity from that. This is actually one of the most inefficient ways of doing it. However, we see people do this all the time, and sometimes it's just plain, it's not even intentional. They just have certain investments that mature and they sell them, not thinking about the fact that they're going to turn around and make gifts later on. And so to try to bring this into a plan and say, hey, let's think about this for a minute. Each year you are probably taking and harvesting some growth out of a particular investment. And then later on, you're making contributions to your local church and doing things like that. So putting it into a plan that actually makes sense and actually provides more money for you. So we're saying maybe not doing that, but looking at what we call the efficient circle of giving. And this is where we take the appreciated stock or real estate, whatever it is that's grown in value, and we transfer it in kind to, you could certainly do it directly to the charity, or to create what we call a donor advised fund. Interesting to know that used to be one of the largest charities in America was the Salvation Army, and now it is no longer the largest charity in America, because donor advised funds, and the one in particular, is now the largest charity in America. And it's because of this idea and this concept that people have really caught the idea of, hey, instead of selling it, maybe I should harvest it directly to a donor advised fund, and then over time I can reinvest that money if I'm not ready to give it all right now, and then I can make distributions to all the ministries that I'm very fond of. So we can do this monthly. We can do this periodically. We can do it with just a simple grant recommendation form. It becomes what I call a charitable checkbook. A charitable checkbook whereby, instead of giving out of your traditional checkbook, you're saying, I'm going to give out of this fund that I've created, and I'm going to give that in a very efficient way to the ministries that I am very fond of.
And Tim, that's a great idea. But as I'm looking through this, I'm thinking, it sounds like it might be really difficult to set something like that up. I almost go back to our guy at the beginning of the webinar, just overwhelmed, and I almost think it seems like a good idea, but how difficult is it to set up something like this donor advised fund that you're talking about?
Not hard at all. In fact, we're going to turn the wheels here, and in fact talk specifically. And here's just an example. Tom and Marilyn Smith. We fill out a simple one-page application. We do what we call usually a DTC transfer if it's a stock, and so we provide you the information there so that you can just very simply make the transfer directly out of your account. Whoever holds that account for you, then it would come directly to the charitable organization. We do really a lot of the heavy lifting. If there really is heavy lifting here, we're going to send you the tax receipt for that. Then the money is going to be in an account of which is a charitable account now. It's not money for you to spend, but it's money that you can use to make designations to qualified charities, 501c3 organizations. So we're going to manage it until the distribution. So anything over $5,000 to get the fund launched. Then, as you see at the very bottom, the donors are going to make grant recommendations to distribute to your ministries of choice. And it's a really simple thing, and there's so many things that you can do with this. I know of people that have multiple donor-advised funds. Sometimes it's to honor a family member that they just had a lot of love and affinity for, and knew that this family member was really very strongly involved in higher education or caring for children or child care or things like that. And so to honor them in a significant way, to create such a fund, which could be rather unstructured as to how the distributions are to be made in the future, or it could be rather structured to say we want so much money per month or per year to be distributed for this particular charitable cause or purpose. And so there's a lot of places you can go with this once we get it established.
But pretty simple to set up.
Very simple to set up, yeah. One-page application, and then if you don't want to use a stock, you can just write a check. We would receipt you in that given tax year as well. So then again, back to our tax ideas, it's a way to get an immediate tax deduction. And it may be that this year you would really benefit from having a very large deduction, but maybe not next year you wouldn't. So then you could use your fund in that way. We're moving on to another idea and a concept here that is a great one for us, and sometimes during our retirement or maybe as we get into our 50s and up. Let's say you have a property it's valued at around $100,000, and if you were to sell that property, there would be a significant gain. In this example, we're talking about $80,000. So the potential tax on that gain could be about $12,000. So what we're saying is we're losing the earning potential of our investment by the fact that we needed to make a sale or we needed to transfer it. Could be a rental property, could be, again, a stock portfolio. A number of different assets could be represented here. So we bought it, we've got growth, we want to increase the value. We don't want to necessarily have a low income, but we need more income. And we don't want to pay the roughly 1/5 in taxes that we would otherwise incur in this type of scenario. So here's just one tool. We wouldn't say that this is the tool that everyone ought to use in this kind of circumstance, because we do have a number of different options that we could consider. But primarily what we're saying is a charitable trust has the ability to bypass gain. It has the ability to increase your income because it avoids the initial tax upon the sale. And then it also, in addition to that, provides a charitable deduction. So instead of paying a tax upon the sale, Uncle Sam's going to give you a deduction, going to put money into your pocket for establishing such an arrangement. And it really doesn't take much to do that. In fact, we start these at as low as $25,000, and we do them up to millions of dollars to help people in a very, in a particular situation that they're in financially. So here again, we're going to put some numbers to this. We have John and Mary. They're in their mid-60s. One of the nice things about this particular tool is that John and Mary can pick the percentage up front that they would like to receive back on this particular transaction. So they're essentially taking this property, putting it into the trust, putting the stock, whatever it is, into the trust. Then it's being sold. It's sold tax-free, and then it's reinvested. Another really key concept is that we're able to take something where we're in a high concentration of position, maybe even a high risk. So if you have one stock that's very volatile, or if you have a piece of one property that you know, hey, it'd be nice to diversify this investment, this is a great strategy, because then you can actually diversify your investment within the trust and make sure that you're properly allocated for your retirement years. And in the situation for establishing the trust, as you see in the lower left-hand corner of the screen, the donor receives a $26,670 deduction, which can be used over the next 6 years, this year plus 5. And then they're going to receive lifetime income, both husband and wife, from this. And we see simple math here, 6% of $100,000 is the income they would receive. If it grows in value, it would be 6% of the whatever that higher value is. So if it grew to be 110, 6% of 110 would be $6,600. Or if it dropped in value, it would be 6% of the lower amount of value if the market had a setback. And as you see, the effective pre-tax rate in this type of a plan is 6.43%. And when we're dealing with people that many times are talking to us and saying, hey, I've got money, it's sitting, it's getting 0.1%, 0.5%, it doesn't take much to see a portfolio like that erode very dramatically over a period of time during a person's retirement years. And in this situation, not only are you going to get more income, but knowing that you're able to select an array of ministries that you're pretty passionate about, that you want to see the kingdom grow, and knowing that you're helping yourself and then also helping this ministry grow is a wonderful tax benefit to consider.
And Tim, the one thing that jumps out to me, can you help clarify this? You had mentioned right away that you have to first give that appreciated asset to this trust. What happens if I decide, you know, I need to sell, and I'm going to sell now, right, and I've sold my piece of real estate, and then I want to enter into an agreement like that? Can I get the same kind of benefit if I sell first before giving that asset to the trust?
Great question, Chris. In fact, the initial capital gain, you're still going to have to recognize on that because you sold it. And we run into that quite frequently where someone says, oh, I wish I'd met you last week, because if I had, I would have done this differently. But so that's the main difference, is that you do not receive that tax benefit of avoiding the gain. You still do receive the charitable deduction that we're looking at on the slide here of the $26,670. So after you sold it, you pay the tax, you take what you got left, and you make the contribution to the trust, which then gives you a significant deduction that you could use to offset that potential tax, but maybe not eliminate it, as we're seeing in this particular example.
It comes down to probably, at this point, knowing that you need to work with somebody, work with an advisor, work with somebody that maybe has, you know, those kinds of details when you're thinking about engaging in an agreement like this, somebody who can come alongside you and give you that guidance. And I'm grateful that we have a team of people here who can do just that. You've met Kirk through our webinar today. Kirk works very closely with two other advisors here at GuideStream Financial, Scott Blakemore and Caitlin Koppelman. And they really have the expertise here to be able to work through some of those issues as they pertain to retirement and those planning strategies that Kirk mentioned earlier. Mark Olson, of course, is the president of GuideStream Financial, and they just are a great team, great group to be able to turn to when you have questions as they relate to financial planning and specifically these retirement strategies that we talked about earlier. And then if you're in a part of the country where you really like to be able to sit down and be eyeball to eyeball with someone and be able to think through some of these strategies and have them, you know, have that be a person that can bounce some things off of. I'm one of those folks who works in the Midwestern part of the country. I work very closely with Kerry Holman, who serves the Gateway Conference and the Wabash Conference. He's in Greenville, Illinois. And then Steve Macaluso is in New York and works closely with Lee Christ, who is in Florida. And those two can really help you if you're on the eastern part of the United States. And then Arnie Brand and Don Bowers, who serve the western part of the country. Arnie's in Seattle, and Don is in Southern California. And then, of course, Tim, who has shared with us today, is available to serve anyone in the United States, and Tim does that with excellence. So we've got an entire team of people. If you're feeling frazzled right now, or you're feeling maybe even a little overwhelmed, and you wonder, what do I do? What of all these strategies, where do I start? Where do I begin? Which one really makes sense for me? I would encourage you to get in touch with one of us. We would love to serve you and help you make some sense of some of these issues, because that's really our heart's desire, is to see each one of you become the very best stewards that you can be of the resources the Lord has entrusted to you.
Thank you, Chris. And we do actually, we're going to open up for some questions here, and we've had some questions that have already been submitted to us, and so we're going to take those questions right up front. But if you would like to throw a question on the pile, we'd be glad to receive that. Please send us an email at webinar@fmfoundation.org. We have a person standing by to receive that email from you, and also to answer it directly. So if you would prefer not to have your question on the air here for us all to hear, you could certainly just make note of that and say we'll give you a reply by email or a phone call back. But for the next few minutes, we'd just like to take some questions that we've been posed with. Again, webinar@fmfoundation.org. And then I think this first one we have here that came in is for you, Kirk. They're asking for us to, again, highlight the differences between a Roth versus a traditional IRA so that they can better understand the differences and how those can be used, I think.
Yeah, that's a very common question that we receive from folks as we're helping them. I have this choice, which one makes the most sense? And the simple answer, the bottom line, is you want to pay the tax when your tax rate is the lowest. So if you are in a higher tax rate when you're working and you anticipate being in a lower tax rate in retirement, the traditional IRA gives you a better tax benefit. If you think you're going to be in a equal or lower rate in retirement, then the Roth IRA is a better tax benefit long term. An example that I dealt with just recently, have a client that is a bank teller, works at a bank, and she's single. When she takes all she itemizes, so when she takes her itemized deductions and takes all of that, she has very little taxable income. So she had this very question: I'm going to make an IRA contribution, should I do Roth or should I do traditional? And so we took a look at her tax return from last year, and her marginal rate, when we figured out what she actually paid in taxes, was almost nothing. So for her to have an additional $5,000 deduction when her tax is zero, there was no benefit to that. So it was very clear in her case that doing a Roth was better, because now that $5,000 grows tax deferred and she never pays tax on the growth. So again, the bottom line is pay the tax when it's the lowest. We do those calculations for folks. You can go online. There's different calculators that do a comparison. You plug in what you think the tax rates are going to be at the two different times, and it lets you know which makes more sense tax-wise.
You know, another thing that I've seen that has been kind of cool, especially with the Roth, if you're in a situation where you want to make contributions, you're younger, and you do that, and then over the years you find that, hey, I have a particular financial need here, or maybe I'm going to buy a house or something like that, or maybe it's the kids' college. You can actually take withdrawals from that account without penalties.
That's correct. For certain items, there's a list of things you can take it out for. So first-time home purchase, medical expenses, education expenses, yeah, those can come out. Great thoughts.
Okay, well, let's take another one. We actually, a somewhat similar question here, 403B versus an IRA. Just try to highlight why they would want to do a 403B. And I'm guessing this is probably a person who works for a non-for-profit organization, very likely is a pastor. And so maybe you could highlight some and contrast the differences between doing a 403B and an IRA.
Sure. And really the answer is applicable to 401ks as well. So again, this is a common answer, or common question, and generally, for most folks, doing the 401k or the 403b allows some more flexibility and tends to be a better option, mostly for two reasons. One, the deferral limits are much higher in the 403b than it is in the IRA. As we saw in the earlier slides, $18,000 to $24,000 can go into the 403b or 401k, $5,500, $6,500 if you're over 50 into the IRA. So they're much higher limits. The other thing is the reporting is much easier. You don't have to put on your tax return what went into the 403b or the 401k. So that makes it very simple. You don't have to write the check to make the deposit. Your employer's putting it in for you. So it's simpler. The limits are higher. The tax benefit's basically the same. So your tax-wise, it doesn't make a difference. But for ease, simplicity, and allowing higher maximums, 403B, 401K is a better alternative. Particularly if you have, if you're participating in a 403B or 401K that the employer is doing a match, that's free money. So you certainly want to take advantage of that. And many employers have a formula where if you put in 5%, they put in 1, or if you put in 10, they put in 8, or all different formulas. But you certainly want to take advantage of those employer matches because that's free money. So
I was meeting with someone the other day, and they were telling me how they wish their employer would give them an increase. And it was just kind of more of a joking thing. And then, so that actually was an introduction to a conversation where they said, I asked him, well, do you have a 401K or whatever? He says, yeah, actually. And in fact, they hadn't been doing that, Kirk. And so by the time we were done with our conversation, it's like, wow, if I just go back and see my HR guy, I can contribute a little bit more to my 401K and I can give myself a pay increase.
3% raise. Yeah, 3% raise.
Such a great idea. Well, we'd just like to thank each and every one of you for being a part of this webinar. No doubt you have other questions. We don't have enough time to deal with them all this morning. But again, if you'll please email us at webinar@fmfoundation.org. Begin the conversation. Feel free to contact any of us. There's no right or wrong person to make connection with. So if you saw a field person there and you want to reach out to them and say, hey, I've got a few questions for you, or if you want to talk to Kirk, myself, or Chris, we're all available and eager to serve you. And one of the nice things about all of our staff here is that no one's got pressure to say, oh, we got to sell something to you or anything like that. It's just not the way we operate here. And we're all salary employees, and so therefore we're here to help and serve you in a way that is most meaningful for you. And so we thank you again for joining us here at this webinar, and we're going to be taking a break for these spring and summer months. We'll be coming back right at it in September, second Thursdays of the month, and so you'll want to pencil that in your calendars and spread the word. We appreciate that word of encouragement that you provide to others and also to us. And so blessings to you. We hope everyone has a happy Easter. Have a good day.
Bye-bye.